Question number 1, page number 125. Shall we?
With effect from 1st January 2012, the consideration was exceeded 11,70,000 based on the firm balance sheet as at 31st December 2009. However, due to some procedural difficulties, the company could be incorporated only on 1st April 2012. Meanwhile, the business was continued on behalf of the company and the consideration was settled on the date with interest rate 12% per annum. The same books of accounts continued by the company which closed its accounts for the first time on 31st March 2013 and prepare following summarized profit and loss account. Cost of goods sold. Sales 2 crores 34 lakhs. Cost of goods sold 1 crore 63 lakhs 80,000. Salaries 11 lakhs 70,000. Depreciation 1 lakh 80,000. Advertisement 7 lakh 2,000. Discounts 11 lakh 70,000. Managing director's remuneration 90,000. Miscellaneous office expenses 1 lakh 20,000. Office cum showroom rent 7 lakh 20,000. Interest 9 lakh 51,000. Profit 19 lakh 17,000. The company's only borrowed loan was loan of 50 lakhs at 12% per annum to pay the purchase consideration due to the firm and working capital requirements. The company was able to double the average monthly sales of the firm from 1st April 2012, but the salaries tripled from that date. It had to occupy additional space from 1st July 2012, for which rent was 30,000 per month. Prepare a profit and loss account in columnar form, apportioning cost and revenue between pre-incorporation and post-incorporation periods. Also suggest how the pre-incorporation profits are debited.
This is 1 crore 17 lakhs. See, the partners of Maitri Agencies, which means Maitri Agencies was a partnership firm. They want to convert this partnership firm into a company. The consideration for purchasing this partnership firm was fixed at 1 crore 17 lakhs. 1 crore 17 lakhs. Based on the firm's balance sheet as at 31st December 2011. However, due to the procedural difficulty, the company was incorporated only on 1st of April 2012. So, which means after incorporation, they buy the company with effect from 31st December 2011 on a retrospective basis. Understood? Same books has been maintained. They are giving information, sales, cost of goods, or various information, and a few other adjustments given. Now, here the salaries has been tripled from that date. The company was able to double the average monthly sales of the firm. Here some more correction. Firm from 1st April 2012. There is no full stop there. It is a continuation of the sentence that the company was able to double the average monthly sales of the firm from 1st April 2012. But the salaries tripled from that date. Understood? So, from the incorporation date, the sales was doubled, but salaries was tripled from that date. Then it had to occupy additional space, all this information given. We have to prepare P&L account, apportioning pre and post. Shall we? Now, let us take one by one. Sales given, cost of goods sold given. Correct? Using this, we will find out gross profit. So, this be working note number 3. 1 is to sales ratio. So, 3 is gross profit. Correct? Then salaries, some adjustments given. So, specific working note number. Depreciation, any information given. So, thereby directly in which ratio? Advertisement, discount, MD, its remuneration, directly to miscellaneous office expense, rent, adjustments given. So, specific working note number. Interest, some information given, working note number. So, thereby we have 6 working notes under presentation. See, time ratio. Time ratio. It is pre-incorporation period. 1/1/2012 to 31st March 2012. It is 3 months. Post incorporation period, which is 1/4/2012 to 31st March 2013. 12 months. We understand they are preparing a financial statement for the period 15 months, not for 12 months. From 1st January, they close their accounts for the very first time by 31st March 2013. So Jan to March of next year, it is 15 months. So thereby time ratio is 3:12 or 1:4. Then sales ratio. So let us take for pre and for post. Number of months is very important factor apart from the sales weight. So we understand that in the pre-incorporation it is 3 months and the post-incorporation it is 12 months. We know that in the pre-incorporation period, if the sale is 1, in the post-incorporation period sale will be 2. And naturally sales ratio 1:2, you may be tempted to say, but the problem is that we should also take number of months into consideration. This is the weight or proportion of 1 month. But in post-incorporation period is not equal number of months we are having. Here we have 3 months, there we have 12 months. So thereby sales combined or combined ratio, it is 3:24. So sales ratio is 3:24 or 1:8. Then we have gross profit. Gross profit equal to sales, how much? 2 crore 34 lakhs minus cost of goods sold 1 crore 63 lakh 80,000, 70 lakh 20,000. So one thing you should always be knowing, at least in the examination, you are given with something. What is that given to you? For preparing, for finding pre and post profit, you are given with what? What is it you are given? In almost all the questions you can see, you are given with a P&L. For the entire reporting period, you are given with a P&L. And that is the profit, total profit of that period. And your breakup cannot be more than that or less than that. A simple confirmation should be that your profit, what you are computing, cannot be more than or less than the profit reported in the question. So in the question, how much profit we have? 19 lakh 17,000. So your total should be 19 lakh 17. This income only you are splitting into pre and post. These expenses only into pre and post. So naturally the summation of profit should be how much? 19 lakh 17. In every problem is like that only. You are not including any additional income or expense. Already prepared P&L, you are re-preparing it with certain breakup. That's all. Understood? Gross profit 70 lakh 20,000. Everybody. Then we have salaries. Salaries, when it has been tripled from incorporation, you can try same like sales concept. You can work out a specific ratio for it. So how? The same basis, it is pre and post. We have number of months, salaries weight combined. We find pre it is 3, post it is 12, 1, 3. So 3:36. So we can say salaries ratio it is 3:36 or 1:12. Now let me work out office cum showroom rent. So office cum showroom rent given as, how much given? 7,20,000. Now please listen carefully. We fix in our mind that pre is 3 months and post is 12 months. Correct? Please respond. And usually we know that office cum showroom rent will be split in the ratio of time. Usually time. But since specific information given, let us analyze such specific information. It has been told that it had to occupy, which means company has to occupy additional space from 1st July 2012 for which rent was rupees 30,000 per month. When it is given as additional space, what you should understand, in addition to the existing place, we are getting more place now. Correct? Please respond. It is not that instead of the existing place, we are having new place. It is additional space is what we are using. Could you appreciate that? So which means in this 7,20,000, after the formation of the company, we have something called additional rent, which is 30,000, and it was paid from 1st July till 31st March for a span of 9 months. So 30,000 into 9, 2,70,000 is called additional rent. Correct? Yes, please respond. Everybody? Yes, so 7,20,000 includes additional rent of 2,70,000, which means we have balance 4,50,000. Understood? Everybody? Yes, so thereby this 4,50,000, we should know that this is the rent for 15 months. Not only in 9 months, or not only for 6 months, not only in pre and all. The company had to occupy additional space, means they will use existing space plus extra space. Understood? So thereby we understand that this 4,50,000 is for a span of 15 months. So whatever space they were using, they continue to use even after the incorporation. So thereby this 15 months should be apportioned into pre and post, that is 3 months and 12 months. So which is 90,000, 3,60,000. We know that this is pre. We know this is post. We know 2,70,000 is also. So total post will be 6,30,000. And 90,000 will be pre-incorporation period. Any doubts in this, please do raise. Understood? So 4,50,000 is for how many months? 15 months. It can't be considered 6 months and all. So thereby rent is 90,000 and 6,30,000. Interest 9,51,000. It was given that the company's only borrowal, the only loan for the company was rupees 50 lakhs at the rate of, and for what purpose this loan was taken? For paying the purchase consideration and for working capital requirement. Correct? So when this loan was taken, is it on 1st January or 1st of April or 1st of July? When the loan was taken? So it was taken on 1st April. Why we understand this 1st April? No date is given because it is payment of purchase consideration. We know that purchase consideration was paid on 1st April. So naturally loan was taken on 1st April. Correct? So 50 lakhs into 12%. 50 lakhs into 12%, 6 lakhs is the interest exclusively relating to post. Understood? So thereby this is only in post incorporation period for the company's loan, borrowal 50 lakhs, 12% it is 6 lakhs. Correct? Everybody? Then balance 3,51,000 naturally should be pre-incorporation period. We can also cross verify that with the help of consideration of 1 crore 17 lakhs For which, what is the rate of interest? 12 percentage into 3 by 12. So 1 crore 70 lakhs interest paid to vendor from the date of takeover to the date of settlement of consideration. So it is purely falling in pre, because on the date of incorporation itself consideration is settled. It is fully pre. Preliminary expenses refers to formation cost of the company. So whatever cost incurred for registration, memorandum, articles, legal fee, all these things are called preliminary expenses. This is nothing but interest paid to the vendor for the acquisition of the business. We have already discussed in several problems interest paid to vendor. Interest paid to vendor means interest paid to the seller of the business. So which will be accounted from the takeover to the date of settlement. If settlement is coming even after incorporation period, then it has to be bifurcated into pre and post. But here settlement took place on 31st March. So it is exclusively relating to pre. But it is not preliminary expense. Preliminary expense means formation cost of the company. So this will be totally will be taken in pre-incorporation period, which is 3,51,000. Proceeding to all the other things, by gross profit, basis sales ratio 1:8, 70 lakh 20,000, 7 lakh 80,000, 62 lakh 40,000. Next, 2 salaries. Specific in the ratio 1:12, 11 lakh 90,000, 10 lakh 80,000. 2. Depreciation. How much? Depreciation. Time ratio 1:4. 1 lakh 36,000. 1 lakh. Then advertisement. Sales ratio 1:8. 7 lakh 70. 6 lakh 2 discount. Sales ratio 11 lakh. Okay. 1 lakh 30,000. 10 lakh 40,000. Nil 90,000. 2 miscellaneous expenses. Sir, twice asked a question in the examination. So every chance it can come in the examination again. It's a very standard question on to profit prior to incorporation. Time ratio 1 lakh. Okay. 24,000. 96,000. Rent. Office cum showroom rent. Specific. Working note number 5. To interest. For the pre-incorporation, we find this resulting into a loss, which we recognize that as goodwill. For the first time we are seeing loss, which will be recognized as goodwill. So which is 19,000 balancing figure. Next, in the post incorporation period is resulting into net profit 19 lakh 36,000. So net profit of 19 lakh 36, loss of 19, the net effect is what? 19 lakh 17,000, which is given in the question. That's all. So it was given that company's only borrowal was with 50 lakhs for the purpose of payment of consideration. Even though there was no date of loan given in the question, but since the borrowal was made for payment of consideration, and in the first paragraph they have given that when the consideration was paid, and it was paid on 1st of April itself, and thereby we understood that the loan was taken on 1st of April, and it is 50 lakhs into 12%, 6 lakhs interest, exclusively relating to post. 3,51,000. If they have not mentioned any interest information, about this vendor, then I would have assumed that either 351 is pre or 351 is applicable for all the 15 months, and I would have apportioned that on time ratio basis. If no information was given relating to interest to vendor, then I would have presumed that either 351 is pre, or I can also assume that 351 is applicable for 15 months, correct? But in this problem, they very clearly they have given the vendor is to be given a consideration of 1 crore 17 lakhs, which was settled at 12% interest on so and so date. And when I computed, it exactly matched with 3,51,000, which is exclusively relating to pre-incorporation period, because from the date of takeover to the date of settlement, that is how it is pre and post. Everybody? So rent and interest is a key here. Maybe salary is also a unique adjustment. Moreover, you should understand that pre-incorporation loss, suggestion is what? Either it can be shown in a separate head called pre-incorporation loss, or it will be recognized as goodwill. I'll tell you one thing, that in a business acquisition, in a company, not like partnership, please listen, stop talking. We acquire a business means, you know what? We are acquiring the assets of that company. See, it is not like something business which can't be seen you can acquire. You are acquiring a business means there is a place. That place is acquired. In that place, lots of assets and machineries will be there. Everybody. That and all acquired. Maybe trade liabilities will be there. So that you agree to pay. That way, what is acquired in a business, it is actually net asset is acquired. Understood? Please respond. First of all, we should be knowing very clear. Business acquisition refers to net asset purchased from a business. Correct? Please respond. Yes, along with that, the brand is also acquired. Everybody. So, we purchase net asset of a business, which is nothing but assets minus liability. In your business, you have 20 lakhs worth of assets, but you have a liability of 5 lakhs, which means I have to pay you only 15 lakhs. Because I have to pay you 15 lakhs, I have to pay 5 lakhs to the outside parties for repayment of liability. In other words, I am paying 20 lakhs for the assets. Understood? So, when you acquire a business, you pay consideration for amount equal to dash. Net asset which is equal to assets minus liability. Sometimes, see, business, how it is acquired? Through negotiation. Correct? Sometimes the negotiation will be only in one direction. What direction? Means, these are the assets we take, these are the liabilities we take, the net amount is say 15 lakhs and we pay 15 lakhs. Please respond. We pay 15 lakhs. Is that clear? Respond, ba? Yes, so that way we are fixing the consideration. The amount, whatever I am paying, purchaser paying to the seller of the business is called the purchase consideration. Everybody? Yes, now the purchase consideration will be normally equal to dash value. Will be equal to what? Net asset. But sometimes the negotiation will not be in that direction. I am not seeing your assets. I am not seeing your liabilities. We are negotiating. Please sell your business. I am ready to pay, say, 18 lakhs. And you are not ready to sell less than 27 lakhs. Respond. Because even though what is visible is assets and, but it is actually a brand which I have created for 15-20 years I am selling to you. Please understand. Anybody who is having these assets and liability worth rupees 15 lakhs cannot make same amount of profit what you are going to make. I have some assets worth rupees 20 lakhs. I have some liability worth rupees. The net asset of my business is only. But doesn't mean you acquire same asset and liability from outside and do business. You can't make the same profit which you will make now if you buy business asset from me. Correct? Please respond. Because this business was in this place for so many years, I have already developed a good brand for the business. Understood? So you will be making more profit. You will be making. So we are negotiating. And I am saying that I am not ready to sell less than 27. You are asking for 18. And some negotiation will be agreed. And imagine we are just settling for 23 lakhs. We are settling for? Then only I am considering the values of assets and. So I am paying how much? I am paying, but the visible assets and liabilities worth only 15 lakhs. That I can't overstate as 23 lakhs. Respond, pa. Missionary now I can't record as something abnormal of 23 lakhs. The net asset is only 15 lakhs. Could you appreciate that? So in my books as a purchaser, what I will recognize means I am buying asset. Usually when I buy asset, what is entry, pa? When we buy an asset, please listen to the discussion, my dear. Don't lose the discussion. Unnecessarily be seated and unnecessarily into different thoughts. Absurd. Please listen to the discussion, my dear. I'm seeing you for the first time, I believe. You are coming regularly? Regularly? Not so regularly. Some days you used to come. So, okay, fine. Once in a moon day, but still it is not a place for coming and sleeping. Okay, if at all you come, you should be listening. Now listen here. So it is like this. So we are buying asset of a company, correct? When you buy an asset, it is asset to bank? Yes, sir. Respond. Now you are buying this asset worth rupees 15 lakhs. Yes, but I am paying a consideration 23 lakhs. Yes, I am knowingly incurring a loss. Yes, so why, sir? Why are you fool to incur this loss? My dear friend, I know that I will get lot of benefits out of this business. Yes, I am not seeing this as only asset. I am seeing this as a business. Something which you can't see, I can see. And this is an intangible asset. And this is what we recognize as goodwill. Understood? So, consideration paid more than the net asset of a company is called goodwill. Net asset of a business is called goodwill. But there could be sometimes where the net asset is 15 lakhs. Net asset? And I am buying your business for 13 lakhs. I am buying your business for? Why is that possible? See, there could be two scenarios. Either buyer may be dominant or seller may be dominant. So when seller is dominant, then it is naturally resulting into what? When seller is dominant, it will be resulting into what? Goodwill for the buyer. Are you following this? Sometimes buyer is dominant. How now? Seller somehow wants to sell this. He is very badly in need of finance. Respond. Very quickly he wants to sell. He doesn't have the time to negotiate with 10 different parties. Understood? So he is about to sell. He is having a huge financial crisis. Maybe Sahara, not Satyam. Understood? So we just find that there is a huge financial crisis. He wants to sell some hotels in China or some other place. Correct? In such sales, what happens? The buyers will exploit. We want this, we will pay this much only. If you want, you sell. We'll give the ready cash is available. See the cash. You want the cash, take it and sign the contract. Understood? So like that, sometimes the buyers are dominant, sometimes seller. I see, we don't want to sell. If you want, buy for 27 lakhs. Like that, the seller may be dominant or buyer may be dominant. Could you appreciate that? So in case of the seller is very weak, he wants money very quickly. See, it happens right from small transaction also. In a lower level, some person wants to sell their land very quickly. He may not be selling at the correct market price, but he can sell taking his own time. He can sell at market price. Otherwise, people will exploit. Could you appreciate that? Everybody. So that way, 15 lakhs worth of asset, there may be a possibility that I may buy only by paying 13 lakhs.
Yes, sir.
It is my profit. It is my what nature? Revenue profit? Is it my business profit? No, it is a capital profit, which is called capital reserve. Which is a revenue nature. I'm sorry. So thereby, the consideration more than the net asset is consideration more than the net asset. Consideration less than the net asset. Capital reserve. Understood? Everybody? Fine. Now listen. When you incur a loss, what happened to your asset position means it will reduce. When you suppose, what is loss then? Say I have 100 rupees. Respond. I invest into the business or I purchase for 100. I purchase for 100. I sell for 90 rupees. Result is what? Loss of 10. What had actually happened to that loss means it have eaten my cash position. Now how much cash I have after this business? I have done a small business. I purchased goods for 100. Respond. Yes, sir. And I sold for 90. Everybody, I got a loss of 10. Now what is the analysis of that loss? The loss have eaten my asset. Now how much cash I have? 90. Originally I had how much? And so first you should know that loss means something that will absorb your net worth, your assets. Are you following this? Everybody? Now what happens is that I am fixing the consideration based on the date of takeover. I am fixing the consideration on the basis of takeover. Could you appreciate that? Please respond. Now what happens after the date of takeover, before the incorporation, the business is having a loss. The business is having a, from what date to what date? From the date of takeover. These explanations are not there in books, my dear. Please listen carefully. They will say simply goodwill, but why it is goodwill? Now listen carefully. So from the date of takeover till there is a, this loss will eat the asset position. Net assets existed on date of takeover. Could you appreciate that? If they were having say 50 lakhs asset, they are making 2 lakhs loss, which means the asset on the date of takeover will become 48 lakhs. But considerations already agreed. Respond. Now naturally what happens? Now the consideration is becoming more than the net asset. Then naturally by you incurring a loss, your net asset is? By you incurring a loss, your net asset is? Consideration is fixed. So the normal, naturally if the net asset comes down, it becomes a position where the consideration is more than the, so thereby the goodwill is actually result in the form of the loss is resulting in the form of goodwill. Are you following? First of all, loss reduces, consideration remains. So that creates a scenario where consideration is more than net assets. Understood? How suddenly it is created? Because of the loss incurred. So the amount of loss is actually a factor of goodwill here. Could you appreciate that? Please respond. Knowingly only you are paying this amount of consideration. Are you reducing the consideration? No. Understood? So knowingly only you are incurring this loss. Respond. So any loss intentionally incurred, here it is only to be termed as goodwill. Could you appreciate that? Now, how this pre-incorporation profit will become capital profit? It is because if you make profit, your net asset will. So company is formed, company is coming on this date and taking over assets and liability. Correct? Respond. Originally on the date of takeover we had only 50 lakhs. How much? 50 lakhs. Consideration also imagine fixed at 50 lakhs. But incorporation date, company comes into existence, taking assets into company's books, 52 lakhs. Because the pre-incorporation resulted into profit of 2 lakhs. and the asset belongs to company only, and they are taking 52 lakhs. But consideration already fixed as, the consideration is less than the net asset. So thereby, naturally the 2 lakhs is resulting into, and why it is resulted at 2 lakhs? It is because of negotiation skill. It is a pre-incorporation profit. Understood? Also thereby, pre-incorporation profit will be capital reserve, and pre-incorporation loss is, okay. What is primarily goodwill? Goodwill refers to the consideration paid over and above the net asset. So the loss of a company during the pre-incorporation period reduces the consideration being. So now what happens? It creates a scenario that the consideration is more than the net asset, and that difference is nothing but goodwill. So thus pre-incorporation loss to be identified as goodwill. Understood? You understood the logic behind why pre-incorporation loss to be goodwill? Pakka? Yes, everybody? Yes, okay. Pre-incorporation profit is capital reserve. Is that clear? Okay, fine. So because they also asked you to suggest how should you treat the pre-incorporation profit, and you will be suggesting that the pre-incorporation profit is normally identified as goodwill. The reasoning is what? The loss will reduce the net asset, thus resulting into consideration being more than the net asset. So the difference is only classified as goodwill. Understood? That is a point you should be knowing. Shall we? Everybody? Pakka? Okay. Now let us move into question number 3.
Kalyan Kumar formed a private limited company under the name Private Limited to take over his exited business. Existing business as from 1st April 2012, but the company was not incorporated until July 1, 2012. No entries relating to transfer of business were entered in the books, which were carried on without a break until March 31, 2013. The following trial balance was extracted from the books as on March 31st, 2013. Particulars: debtor, debtor. Stock April 1, 2011.
It's 2012.
4,300. Sales 27,800. Purchases 18,900. Carriage outwards 330. Travelers commission 750. Office salaries and expenses 2,100. Rent and rates 1,200. Kalyan Kumar's capital account 1/4/2005 23,000. Director's fees 1,800. Fixed assets 13,400. Current liability 3,700. Current assets other than stock 11,200. Preliminary expenses 520. Total 54,500. You are given the following information. Stock March 31, 2013, 4,400. The purchase consideration was agreed at 30,000 to be satisfied by the issue of 3,000 equity shares at 10 rupees each. The gross profit margin is constant and the monthly sales in April, February and March are double the monthly sales for the remaining months of the year. The preliminary expenses are to be written off. You are required to assume that carriage outwards and travelers commission vary in direct proportion to sales. You are required to prepare trading and profit and loss account for the year ended March 31st, 2013, apportioning the periods before and after incorporation and a balance sheet as on the date. Ignore depreciation.
Anyway, directly discussion. The company was formed on 1st July 2012 to take over the business with effect from 1st of April 2012. We find that the accounts were closed on 31st March 2013. The financial statement is for 12 months. They are asking you prepare trading account, P&L account and balance sheet. We will prepare trading account, not apportioning pre and post, trading account for the entire period. We will have P&L account with apportionment pre and post. We will have balance sheet. So please understand, the income statement what we are preparing is not for reporting, only for computation purpose of pre and post. Whenever you prepare the balance sheet should be in accordance with the Schedule 6. Understood? So which means you should be remembering the Schedule 6 format balance sheet. We'll have two parts, equity and liabilities, assets. Equity and liability, 4 items. Shareholders funds. So Schedule 6. Schedule 6 we have equity and liabilities, assets. Under that equity liability 4 categories. Assets we got non-current assets. Anyway, coming back to this problem. So we are going to prepare solution as trading account, P&L with breakup, balance sheet, and wherever required we will also present notes and also working notes. Shall we? Notes is notes to balance sheet. Working note is for the entire solution. Correct? Now take one by one. Stock on April 1st, 2012. We are not preparing opening balance sheet. This will come in the trading account. Sales, purchases, carriage, P&L account. This is carriage outwards. Carriage inwards only will come in the trading account. Carriage outwards will come in the P&L account. We have travelers commission. Travelers commission will come in the office salaries and expenses. Rent and rates. Kalyan Kumar's capital will not come in company's balance sheet. In a company's balance sheet, you can't have a proprietor's capital. Now what happens, later pages, later information they have given that the consideration was agreed at rupees to be satisfied by issue of 3,000. See, you know what you are acquiring net asset. Net asset means nothing but assets minus liability. The assets minus liability is nothing but capital. Understood? So thereby your net asset existing on the date of acquisition was this much amount. How much amount in the capital? How much amount? 23,000. But for 23,000 net asset, consideration is given as 3,000 shares of rupees 10 each, 30,000 rupees. Correct? We are giving more consideration. That will result into loss, which will be recognized as goodwill. So thereby, instead of 23,000 in the balance sheet liability side, we will show in the liability side 30,000. Will show, and in the asset side we will show 7,000. Could you appreciate that? Instead of 23,000 in the liability side as capital, we will have in the liability side under equity and liability, under shareholders fund, under share capital will show. And below that important note is shares issued for consideration other than cash, because you are issuing the share for buying a business, not for issuing shares for cash. Understood? So you will be providing that note also in that note to share capital. Shall we proceed? And in the balance sheet asset side you will show non-current asset, fixed assets, intangible asset, goodwill will be shown 7,000. Clear? Okay, fine. Next, after capital, directors fees will be directly shown in, directly allocated to post, P&L post. Next, fixed assets, balance sheet, and we are presuming it is non-current asset, under that fixed asset, under that tangible assets. Next, current liabilities directly will be shown in the liability side. Then current assets we will show directly in the balance sheet asset side. Preliminary expenses, written off, it will be shown in the P&L account in the post incorporation period. Understood? So working note number 1, working note number 2. So these are the basic 2 working notes required. No other item we find working note. Correct? Maybe working note number 3 could be that capital adjustment. Correct? Capital, which is assets, net asset 23,000, purchase consideration 30,000. So difference is 7,000, which is goodwill. Like that you identify 3 working notes you present. Understood? So trading account, P&L account with apportionment, balance sheet in the format. Please try. The first requirement is time ratio. Pre-incorporation period, it is 1/4/2012 to 1/7/2012, 3 months. Post-incorporation period, 1/7/2012, 31st March 13, 9 months. Time ratio is 3:9 or 1:3. We have sales ratio. sales ratio, pre-incorporation period, Jan illa, April, June 2012. Post incorporation period 2012, July, August, September, October, November, December, Jan, Feb, March. It's given that sales during April, February and March will be double. Pre. All other months it is normal sales. It is 11. So sales ratio is 4:11. Purchase consideration. Capital on 1/4/2012, that is net asset equal to rupees 23,000. Purchase consideration, shares of rupees 10 each, 30,000, resulting into goodwill of 7,000. Everybody? Now taking one by one item. The first item being opening stock will come in the trading account. Opening stock how much? 4,000. Next, buy sales how much? 20, 27, 800. Two purchases how much? 18,900. Buy closing stock 4,400. So to gross profit 9,000. Now let us take other items. By gross profit, okay, carriage outwards, sales ratio 330, 80, 240. Next, travelers commission, sales ratio 4:11, 750, 200. Okay. Office salaries and expenses 1:3, 5. Okay. Director's fee. How much? Preliminary expenses. That's all. So to capital reserve 1 to net profit 10. Now listen, share capital. We do not know the authorized share capital. Issued, subscribed, called up and paid up. Equity capital 3000 shares of rupees 10 each. It is 30,000. In that, shares issued for consideration other than cash 30,000. Generally, a part of total capital may be issued for cash other than cash. Here, entire 30,000 shares issued for consideration other than cash. Reserves and surplus. Capital reserve 1287. Surplus. Balance in P&L 1013. 2000. Current assets other than stock 7,000, 11,200. Then stock, that is inventories. 15,000. So disclosures, whenever balance sheet is presented, disclosure is very important.